Most traders believe losing trades are what destroy their accounts. But when professional trading desks review retail accounts, they often find something unexpected. The entries were correct, the market even moved in the predicted direction, and yet the account still struggled to grow. The problem was not the losing trades. The problem was what happened when the trader was right. Because many traders close their winning trades at the exact moment professionals begin paying attention. Winning, it turns out, creates a psychological pressure many traders never learn to manage. And that pressure quietly destroys the asymmetry trading requires to succeed. The position becomes profitable. Immediately, the brain begins calculating risk again. What if it reverses? What if this profit disappears? So the position is closed. Relief follows. But something critical has just happened. The trade was not closed because the market invalidated the idea. It was closed because uncertainty became uncomfortable. Professional traders understand something different. Markets rarely produce meaningful profit in a straight line. Large directional moves develop slowly through expansion and retracement, which means one rule quietly governs professional exits. The trade is not closed because profit exists. It is closed when structure completes or fails. Once a trade becomes profitable, the brain begins treating that profit as owned money. So when the market retraces, the trader experiences the movement as loss. Even if the position remains positive, this creates pressure. Every retracement feels dangerous. Every candle feels threatening. The trade is closed early, but professionals evaluate something different. They ask, has the trend structure changed? If the trend remains intact, the retracement is not a reason to exit. It is simply the market breathing, which is why institutional traders often place profit targets near structural expansion zones, not emotional comfort levels. Examples include previous liquidity pools, major higher time frame resistance, measured expansion of the prior impulse move. These areas define where profit logically matures, not where anxiety appears. Think about the last profitable trade you closed early. Did the structure actually fail, or did the profits simply fluctuate? This moment reveals something important. Most traders are not managing trades based on market logic. They are managing them based on emotional tolerance. Professionals reverse this process. They determine exit conditions before the trade begins. Two exit scenarios are defined: structural invalidation, structural completion. Once these conditions are set, the trade no longer depends on emotional interpretation.
Retail traders attempt to manage every movement. Every candle becomes a signal. Every small pullback feels like danger. The trader begins interfering with the trade, reducing size, moving targets closer, closing early. But markets do not reward constant intervention. They reward alignment with structure. Professional traders separate trade management from price observation. Positions are managed through structural signals such as high or low formation during an uptrend, break of structure continuation, liquidity sweep confirming expansion. As long as these conditions remain intact, the trade remains valid. Profit is not harvested simply because it appears. It is harvested when structure completes the move, but the consequence of micromanagement appears after the trade is already closed. And that is where most traders finally notice the pattern.
The trader closes the position. A small profit is secured. At first, it feels responsible, disciplined, safe. Then the market continues. The same direction, the same structure, the same expansion. What looked like smart risk control slowly becomes something else, a pattern. The trader begins noticing the repetition. The analysis was correct. The entry was correct. But the management destroyed the opportunity. Professional traders expect something very different from their trades. Most positions will remain small, some will fail, but occasionally a trade enters a large expansion phase. Those expansions carry the majority of the system's profitability. Closing winners early remove the only trades capable of producing those expansions. And when this pattern becomes clear, the trader finally realizes something uncomfortable. The problem was never the entry. It was the inability to let the market finish its move. Many traders unknowingly pursue a dangerous objective. They want every trade to end in profit. Small wins feel responsible, controlled, disciplined. But that objective quietly changes how trades are managed. When profit appears, the trader begins protecting it. Targets move closer. Positions close earlier. What feels like discipline slowly becomes profit avoidance. Professional traders understand something uncomfortable. A trading system does not require frequent winners. It requires correctly managed winners. For this reason, profit objectives are not emotional decisions. They are structural destinations. Professional traders often position targets at logical market objectives, such as equal highs or equal lows, higher time frame supply or demand zones, projected range expansion levels. These levels represent areas where liquidity naturally concentrates. The trade is not closed because profit exists. It is closed because the market has reached its structural destination. But once a trader begins noticing these missed opportunities, a new psychological cycle begins. And that cycle becomes even more difficult to control. After repeated early exits, the psychological pressure begins to change. At first there is relief. The trader protected profit. Nothing was lost. Then curiosity appears. The trader notices the same pattern repeating. Trades close early. Markets continue moving. Eventually curiosity becomes frustration. The trader begins asking a difficult question. Why does price keep continuing after the position is closed? So the next time a trade moves into profit, the trader attempts to hold longer. But something unexpected happens. The emotional pressure increases. The longer the trade remains open, the more uncertain it feels. And once again, the position is closed too soon. The cycle repeats. Not because the trader lacks knowledge, but because the tolerance for uncertainty inside profit has not yet developed. Professional traders solve this problem before the trade even begins. They define 3 structural elements in advance. Invalidation level, the point where the trade idea becomes objectively wrong. Structural continuation points, locations where the stop can move as the trend confirms itself. Profit destination, the area where the market is most likely to reach if the move fully develops. These destinations are rarely chosen at random. They are often based on structural market logic such as higher time frame liquidity pools, projected expansion ranges, imbalance or inefficiency targets. Professionals understand something simple. Profit is not guessed, it is mapped. But mapping the trade is only the first part of the discipline. The second part is following the structure once the trade is active. Professional traders treat profit management as a structural process, not an emotional reaction. Before entering a trade, they ask 2 questions. Where does this idea fail? And where would this idea logically complete? The first question protects capital. The second defines opportunity. Between those 2 points, the trader does not attempt to control every movement. The market is allowed to fluctuate. Pullbacks occur, liquidity is taken. Continuation is confirmed. Structure defines the exit. Everything else is simply the market unfolding. But even with a clear structural framework, one final obstacle remains, and it has nothing to do with analysis. Professional trading desks sometimes observe a simple behavioral test. If a trade becomes profitable, can the trader allow the market to fluctuate without interfering? If the answer is no, the trade will likely end too early, because the trader is reacting to profit rather than structure. Profit begins to feel like personal property, and once that happens, protection replaces patience. The trader begins defending the profit, managing every movement, closing positions prematurely. The structure remains intact, but the trade is already gone, and this is where most winning opportunities quietly disappear. Winning trades rarely disappear because the market reversed. They disappear because the trader closed them. The discomfort of uncertainty becomes stronger than the logic of the trade. So the position is ended early, the market continues, and the trader is left with something small, where something significant could have existed. Many traders believe their greatest challenge is predicting the market, but prediction is rarely the real difficulty. The deeper challenge is remaining calm when the market finally begins doing exactly what you expected. This is why many traders quietly sabotage their own success, not because they cannot find good trades, but because they cannot allow good trades to fully develop. If this changed the way you see your winning trades, continue the training.